This video segment is a small part of what the Market Guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.
Well, good evening, everyone. This is AJ Monty, Chief Market Strategist with the Market Guys, and I'd like to welcome each and every one of you, particularly the new folks who have found out about the Market Guys through either Twitter, Facebook, Snapchat, LinkedIn, Instagram. Do I have all the social media bases covered? I think so. And what's really interesting is that today is, of course, it's Monday the 18th, but we are coming into the last weeks of the fourth quarter, or the last weeks of the trading year, and we're obviously seeing a strong effect of the Santa Claus rally taking a hold of our markets. And so tonight what I'm going to do is go over the general markets, as I usually do. And then, if we're lucky enough to get the mic situation taken care of, we're going to go ahead and bring on my good friend Joe Spinelli from the trading floor. If that doesn't work, then we'll save him for another time. No pressure, Joe. Just work on that and see if we can get you live on here. Now, I want to talk a little bit about the cycles of what we're seeing in the market. The diamonds, which I'm going to put up here on DIA. There we go. This is the diamonds. It's the Dow Jones Industrial Average ETF. And as you can see, I left my forecast line. This was Friday, where we had a doji, and on Thursday we had a bearish engulfing pattern here. These two, or I should even say these three candles right here, are fairly bearish. Now notice what happened today. We gapped up. That's a gap, very close to a doji, which would be called an evening star. You could even look at that almost as an inverted hammer. But by definition, that is a spinning top. And we saw the market gap up on lower volume. See the volume down here? Today's volume is roughly 25 to 30% less than what we saw in the volume on Friday. So we see the market gapping up on significantly lower volume. Now, if you've been following along with the Market Guys long enough, you'll know that that is not a sign of strength. In fact, it's the opposite. When you see a small-bodied candle, even setting a new high, and you see that on lower volume, it tells us that the buyers are actually starting the weekend. You know, we have economic news this week. We had talks of interest rates from the FOMC. We have economic news and political news from Washington regarding the tax reform bill. You know, lots of bullish things happening. Unemployment numbers are at 17-year lows. It just goes on and on. But technically, the market is still considered to be in an overbought condition. I'm not going to call the Dow a bubble at this point, but I'm going to go on to show you some of the other signs that I'm looking at that lead me to believe that we have to still remain very defensive as we come into 2018 for the new trading year. And so, and let me just take a quick break. Joe, if you do hear my voice and you hop on, just interrupt me. Just don't worry about waiting for a pause. Just cut right in there if you get on there. Okay, so this is the Dow. Now, before I go to the S&P or the other indices, I want to go to the VIX, because the VIX, again, in my opinion, continues to be the leading indicator that we want to focus on the most. As you may have seen from my weekly market report that went out on Friday, this horizontal line down here is still record lows for the VIX. Now, it is very possible that the S&P hovers, the S&P VIX, I should say, volatility index, this could very well hover on the lows as the market continues to reach for higher highs. But I don't think that's going to happen forever. And you know that if you've been following the VIX, it's an oscillating indicator. It's not a trending index. It oscillates. And so we've had these spikes of the VIX going from 9 to 17, back down to 9 and up to 14. You know, it's amazing the volatility spikes that we've had. And so we definitely want to keep an eye on the VIX. And as I mentioned in last week's report, my forecast was that we would see a bounce in the VIX. I'll zoom in here for you so you can see what I did. This was a 2-week forecast where I said the VIX would pull back and then rally. And I still feel that by the end of this week, we could still see a dramatic increase in the VIX, maybe by about 10% in price. I still have that end of the line there being my target for the VIX. So if you're long any stocks, particularly any stocks within the S&P, the VIX is basically talking to you right here and saying that you should be protecting your profits on the way up, and not to get out of control with your buying activity and just keep buying. You got to be very cautious. Buying the dips, protect below key support levels, and then just watch as the VIX starts to go up. You have to more or less be trailing your stops. So keep an eye on that VIX. You know, if I go back 20 years, I mean, look at this. It's incredible. We're on 20-year lows, and it's all-time lows for the VIX. And that alone, in and of itself it tells me be cautious. Okay, now let's look at the Russell 2000, which is a more broad-based index from the S&P. Obviously, the S&P is 500 stocks. Russell 2000 is 2,000 stocks. And again, like I said in the weekly market report, we could have a mixed bag of volatility this week where one market might go up, another market might go down. I don't expect the markets to be in sync this week. I think we're going to have different points at which the markets are going to pivot. But you can see this was my forecast line for last week for the Russell 2000, and we've already hit my target. Today, Monday alone, the Russell 2000 showing a big, strong green candle, hitting my target. And remember from the report that this was my resistance area that the market will most likely test. So if you start to see the Russell 2000 move up, hit this resistance and start pulling back, again, that's the charts telling you, be cautious, trail your stop up, protect your profits. Don't turn a winner into a loser, things like that. That's where the technical analysis really comes into play to be able to really use the charts as a risk management tool more so than a forecasting tool. Okay, let's go to the Qs. This is the NASDAQ market. I'm going to spend a little bit more time on the Qs than I have the diamonds and the VIX and also Russell 2000. As I zoom in here, I have my forecast line from last week. We've already hit my target right there, the end of the line being the target. We've already hit our target for the Qs today. The Qs have gapped up in almost a vertical 3-day rally. Look at this, from what we see here back on the 14th and then the 15th and then, of course, the 18th, almost vertical price action. Today, the volume is just above half of what it was on Friday. So just like what we saw earlier, the drop in volume is a signal that the buyers are weakening. So again, another reason to move your stops up and protect. This line right here, see this former resistance. I'm going to give you a test question here. Let's see who's been following us along over the years. Here is a resistance point taken from the high back on November 28th. When resistance is broken, like it was on Friday, what does this line turn into? It was formerly resistance here. How do we treat that line now? How do we look at that? I'm going to go to my Q&A box down at the bottom, see who's the first one to answer. Wow, massive action on the answers. Mike, George, Joe, Greg, Herschel, Nathan, Tim, all of you, Amalia, Ralph, Lloyd, you're all correct. Ken says it a little bit more specifically. Resistance becomes support. Thank you, Paul. You're absolutely right. And so now that we've hit the target, it would not be out of line to think that the market will at least pull back to this new support level. Okay, now here's test question number 2. Again, helping you develop your skills for reading the charts. This blue line, as we define it as the 20-period moving average. Oh, Joe, I hear you. Is that you? I heard someone come on there. Let's see. Joe, do another test. Is that you coming on? Test, test. Oh, almost had it. Almost had it. Okay. All right. If you work on that, you again interrupt me. So the blue line represents the 20-period moving average. The price has stretched far above that moving average. We call that a price divergence from the moving average. I will most often talk about the rubber band effect, and that imagining the rubber band with one end being connected to the moving average, the other end to the price, the rubber band is being stretched. So again, in the weekly market report, I said we would rally, hit the target, but I didn't go any further than that. But here tonight, I can, because we have more data to crunch. Now that we're gapped up on lower volume, hitting my target, and we're stretched from that moving average, we could more or less expect a pullback, at least in the near term, or even later in this week. We could start to see a pullback. Now, let me give you a little bit more information to help you understand market behavior, okay? When we're reaching the end of the year and people are seeing the Santa Claus rally and they're buying and they're long, let's say the majority of you on this call are long the market, whether it be in an index, a mutual fund, an individual stock, whatever, you're long. And you're looking into next week and even into the week after next, and you know that on Monday the 25th, the markets are closed. And on January 1st, you know the markets are closed. So you now have 2 back-to-back weeks where there's a shortened trading week. You also know that that's a big holiday break for a lot of people. Students from college come home, visit with their parents. Parents take off. They do some trips. They come to Florida. They bombard my backyard in the areas of Disney and beyond. And so what happens is before the end of the year or before people go on holiday, they'll start to sell some of their positions in an effort to take their profits. A profit-taking move, for the most part, is considered bearish. If you've ever listened to any reports, or even if you listen to Jim Cramer or Fast Money, if you listen to my friend John Nigerian and Pete, his brother, you'll hear terms being used. Hey, it's profit taking, and that generally means a short-term sell-off as the sellers come in to sell in an effort to take their profits. The sheer number of people taking profits starts to put pressure on the market. Now, don't get me wrong. This does not mean that we're going into a massive breakdown or sell-off or correction in the market. Profit-taking is usually very short-lived. So while we're expecting that to happen, you must also understand how fund managers and hedge fund managers especially manage their own positions. And I'm going to tell you, this is going to fall right in the category of manipulation. It's not illegal manipulation. It is, however, it is labeled manipulation in that, imagine now you're not private investors. Imagine you are, let's say you're just money managers or fund managers that are trading, and you say, okay, I have a position in, let's say, Tesla, okay, Tesla Incorporated, and it's an expensive stock. All right, now follow me here, because this is a very, very important part of trading and understanding the markets. I'll call this investor IQ. This is what it falls into. Now, you're all fund managers. You have all, for the most part, bought in to Tesla. Let's say at the beginning of the year, you bought it down here at around 220. It's up well over $100 a share from where you bought it, but you have not realized your profits in it yet. So again, you're a money manager that's going to get paid a bonus on how much money you make for the fund. Now, here it is, the end of the year. You want to get a big fat bonus. So what are you going to do? It's basically an exaggeration or a magnification of what I've just talked about, a profit taking. If you're an investor taking profits in one or a few stocks, you're going to push the market down as a group of investors taking their profits. Well, put that whole concept on a larger scale. Now you have money managers that are taking profits at the end of the year so they can bank the profits and get paid their bonuses on a record year for them. And look at what's happening. Now, Tesla is one of those institutional stocks because it does have a high price per share, so they can move a lot of money by trading a stock like this. And lo and behold, today, what do we have? Bearish engulfing pattern with a gap below the market, with a long stretch above the moving average. These were my forecasts, by the way, for Tesla going back a while. And now we have a bearish engulfing pattern. You see? Now, take the examples I've just given you with an individual investor taking profits and a hedge fund manager taking profits. And now you look across the board and you see many, many people starting to do this. Well, that's another reason why you need to protect your money. Now, finally, let me give you the big picture in what we call the January effect. Let me know the check. Is Joe Spinelli online yet? I don't know. Kenny, are you able to help him or not? Let's see. See if that microphone's still on. Joe may have let me just check. I got to check. I would love to have Joe on the line with us here. I want to put pressure on. It looks like he rebooted. From the looks of it, he's off. Oh, there he is. Okay, Joe, I'm gonna turn your mic on again. Let's see. Hold on. Do I have you? Check. Do sound check. Your mic is open. Okay, not yet. Okay. So what is the January effect? The seasoned investors who have been following along with us know what it is, but it can't hurt to really go over this again. The January effect, and what I'm doing is I'm actually using building blocks to kind of work you into the cycle, all right? The January effect is a combination of what I've just talked about with hedge funds selling out of their longer-term positions to bank the bonus. So they sell out of a stock like Tesla, which is a large cap stock, okay? And they bank the profit, they get paid on that, but they don't sit in cash. What they do is they sell a smaller number of Tesla shares to buy a longer number of a cheaper stock. It might even be like one of the positions we just took in IAU. It might be the selling out of a $300 stock to buy a smaller one that's priced at $12, or again, a mid-cap stock. So think about this. What happens is they move a lot of money out of the large cap stocks and they start bidding up the small cap stocks in an effort to rally those to make a shorter term profit in the first quarter of the next year. I hope you follow that, because if you just followed what I said here, then that alone is enough information to make it worth your while to sit on this webinar today. These cycles take place over and over and over again. And understanding cycle theory and the different behavior patterns that are cyclical, it's going to help you quite a bit. Here's one that I talk about all the time. It's almost a joke, but it's true. We tend to buy Hershey in December and we hold it till February. Why? Because, Joe, I know you hear me, but I still don't hear you. I don't know what's going on, but we'll see. See if Kenny can help you with that. All right, so here's the joke, really. But look at the cycle. All right, here's 3 years of history for Hershey. Now let's look at just last year, 2016. December of 2016, you could have bought it at 84. And if you held it to February, it's now trading 92, 93. Okay, and you would have captured that leg. You would have made a lot more had you held on. But again, the strategy is to buy it in December. Here we go again. 2000. Here's December right here, 2016 going into 2017. If you had bought it here, you would have bought it at 98, and you would have rode it all the way up here to 106 or more, depending. February right here, maybe 110. See the cycle? Now here we are in December of 2017 going in. Now notice, again, I'm kind of giving you a freebie here, and this isn't an absolute 100% it's going to make money, but there's a good chance it will, because this is a weekly chart now. Look at the candles building up as the volume is increasing on Hershey. All right. Now, every year I talk about Hershey, every single year for many years, and I use it as the example. But I found other stocks, and listen, take this as educational content right now. I went in to get my tires rotated on my truck, and I went into the tire store, and I see all these advertisements for, hey, turn your tax check into new tires. You know, they're doing this tax sale thing. And I asked the tire guy, I said, listen, let me ask you, when is the busiest time for you guys with selling tires? Is it now? Do people go out there and buy tires as a gift for their loved ones, family, whatever? He says, no, actually, this is the slowest time. So I said, well, when is the busiest time? He said, actually, it's during tax season, the first quarter from January, February, March, and even into April. People start buying because they may even put it on their credit card and pay it with their tax bill when it comes in. A lot of people buy tires. So I started checking, and I noticed Goodyear tires. Now for the Oracle subscribers, don't get in. I'm looking at this as a possible consideration for our next trade candidate, because it's a pretty low price stock. Don't get in yet until I send out the alert. But look at the cycle again, right here. Here's 2016, January, February, March, April, boom, right? Look at again, January, right here, February, March, April. See the spike up here? This is where it went from 31 to 37. You see? Now there might be an option play in here as well. Here we are coming in. I'm thinking, again, if it looks good and we can protect ourselves, the price potential or the price rally potential could be from 31 all the way up to 37 again as it tests resistance. I can go back even further on a monthly chart and say, well, okay, let's check this out. Here we go. Every month, every number, it represents the new year. You could see that almost every year you had bought it, even in 2007, right before. I would have to say 2008 would have been the exception to the rule where you would have lost money. But the large majority of the time, had you bought at the beginning of each year, you would have made money. You see? So these are cycles that I constantly and continually try to explore, because if I can find a behavior pattern, or if I'm digging into a business and I hear right from one of the employees, this is their cycle, then that means money to me. And that's what we have to do. We have to learn how to get in front of the wave. But most importantly, we have to prepare if that cycle happens to break on that particular day that I buy it. You always have to assume that the next trade you're getting into is going to lose. I know it sounds crazy, but that's actually how you have to protect yourself. If you go into a stock, you have to say, okay, what if I'm wrong? Where am I going to get out? Where am I going to protect myself? You see, so right here, again, analyzing GT, which is Goodyear tire. This to me looks like a cup and handle pattern. So the buy isn't quite there yet. But if I see a breakout over this high, right around 32.5, I might very well get in and then put my stop right there. Okay. to work on the computer. Okay, so I'm getting a report that Joe is going to try to call in over the phone. And let's see, Joe, is that you? Oh, I'm hearing clicking. What the heck? All right, Joe's going to try to call in over the phone and see if we can get him that way. All right. Now, I'm going to, before we get into your stocks, I'm going to talk a little bit about the gold market, and then if Joe's able to get on, he could more or less complement what I'm saying in our conversation. All right. Now, the gold market is a very, very volatile market, especially when you're talking the futures markets. But the gold market is starting to get a lot of press because of this cryptocurrency craze that's going on. Now, let me first disclose that I do not own any cryptocurrency or Bitcoin or anything like that, nor do I ever intend to take a long position in a cryptocurrency. Now, that doesn't mean I may not trade options on that underlying. I might one day. I might trade an ETF or two. If they come out with an ETF for cryptocurrencies, I might. But the market is too new and too volatile for me to trust it at this point. And it's because of this Bitcoin craze that gold and silver are starting to really percolate, because for thousands of years, the gold market has been the global currency. And so there's a whole history I'm not going to get into right now with how gold was eventually brought in to be linked with the dollar, and the Federal Reserve was created, and then eventually, Richard Nixon delinked it in 1971. There's a whole history of how all that happened. But what's happening is, and I'm telling you this almost as a caution flag, if any of you are getting approached or hard sold or hyped up about the Bitcoin market, I'm not telling you not to get in. I'm just telling you to be extremely, extremely careful with that market, because I see a huge, huge bubble that, in my opinion, is going to pop. Now, again, it's not a buy or sell recommendation. I'm going to pull up the New York Bitcoin Index so I could show you what I'm talking about, okay? This is the weekly chart of the New York Bitcoin Index since inception. Now, I want you to pay very close attention, because I've been tracking this from the very beginning, drawing these trend lines. You see down here? Look, these are the trend lines that I drew. I drew an uptrend line from here to here. These are also known as fan lines, and I'll be opening up for questions here in a minute. If you want to type some questions on this chart, go ahead. Joe says unmute me. Let's see if that works. Let's see. I'm still trying, Joe. Hold on. Where did he go? Oh, we have so many people in here. I got to scroll through all the names. All right, let's see. All right. Joe, I'm going to try one more time to unmute you and see if that works. Oh, there he is. I'm unmuting you right now, Joe. Boom, boom, boom. You're unmuted. Have you yet? Okay. All right. That's going to be the last time, Joe. I'm going to leave your mic open, but if you figure it out, we'll figure it out for the next call for sure. So this market right here is when I started tracking the trend. Now, a fan line is when you draw a trend line and then the trend starts to accelerate. So more or less what you're doing is you're gauging the angle or intensity of that trend, okay, in an effort to see how extreme the trend or momentum is. Now, every single time, the way you do a fan line is you draw one trend line with 2 points. Then you take the last point on that trend line, and that becomes point number 1 for the next most accelerated trend line. You see? So I take this one, draw it to here, and extend. Okay, trend accelerates. What do? I'll zoom in again. Okay, so trend accelerates. And what do? I connect the dots, and it continues to go up. Now, look at what's happened with this. Never before in my 35 years of trading have I ever seen 9 fan lines in a row without being broken. Never have I ever seen it. So what's happened today is the most recent fan line, which is fan line number 1, is now we're going 3 weeks. Actually, it's one, two. This little blip up here is what happened today on Monday. It gapped up today. This is the most extreme and the most vertical line on the Bitcoin index. Now, again, whether you trade Bitcoin or not, the lesson here is in the fan line. Now, when a fan line breaks, when they finally break, I can guarantee you, and this is what's happened every single time I see fan lines break. When the fan line breaks, there's almost, I'm going to say 99.99% chance that once that fan line breaks, it'll gravitate back down to the next fan line in that sequence. And as the fan lines break, they continue to go and stop at the next fan line in the sequence. So again, let me reword this for you. There's 9 fan lines, with the most vertical fan line being number 9. If 9 breaks, it goes to 8. If 8 breaks, it goes to 7. If 7 breaks, it goes to 6. You see? So this is how we define the bubble. This is how it is. Now, when Joe Spinelli and I got involved in the gold markets back in 1982, gold had just peaked out of an $800 bubble. It had broken its fan line. The gold craze in the early 80s was wild, and gold went through a major correction. And in fact, once the correction had taken place, gold then stayed in a 20-year bear market. It continued to show lower highs for 20 years. It wasn't until 2005 that gold, and 2005 to 2008, that gold hit the bottom and then went back up into a massive rally. You see, so these fan lines are extremely important for you to learn. They're great for defending your position, and if you're so inclined to take a short position in the market in any stock, if you see an extreme fan line and it breaks, that might be a good idea for you to take a short position. For the option traders, that might be a good idea to buy puts or sell call spreads or buy put spreads, whatever is bearish at that particular time. And then you'll be able to reposition yourself according to how the technicals pan out at that particular point. Now, another thing with this vertical trend that we're seeing with Bitcoin is that the index itself is leaving multiple gaps. There's a gap down here still open. There's a gap here still open. There's a minor gap still here open. There's a gap here week after week. It's gapping up. And my theory behind this, and it's backed by a lot of evidence, but it tells me that there's a lot of hype in this market. Now, again, the futures have been trading now for just about a week. The CBOE and the CME have introduced futures and options on the Bitcoin. And that's what I was going to bring Joe on to talk about with regard to gold inventory and how the futures markets are now absorbing these Bitcoin or cryptocurrency markets. Understand that the exchange itself does not, just because they offer a contract, doesn't add credibility or reliability to the underlying contract. Let me rephrase that. Just because an exchange opens up trading on a particular contract, that doesn't mean that's a safe market or a long-lasting or guarantee that that market will be around. In fact, Joe Spinelli and I were trading the bond index options when they first brought that to COMEX, and it was going like crazy, the bond index. And then all of a sudden, boom, they stopped trading it, and the contract went away. It vanished. Now, I think Joe was in that position too, but I lost a lot of money in the bond index options because it didn't last very long. The exchanges are always looking for new things to trade, because when they open up the floor for trading, they're able to generate commissions, which in turn helps the members, helps the exchange generate revenue. Every time someone gets in, every time someone gets out or places a spread, they're making money. You could trade weather futures. You actually could. You can go to Las Vegas and bet on you can bet on football games, right? I mean, it doesn't mean that it's something that you're going to invest in long term. It's an instrument that you can make money from. But I'm just telling you, this is not to be a pro, Bitcoin guy or an anti-Bitcoin guy. I'm just telling you this because I want everyone to watch out. I'm probably one of the only voices that you're going to hear, voices of reason, that are going to talk about this in more or less waving the caution flag. Everyone else is just jumping on the bandwagon, pumping it up. And to me, it almost feels like a big, horrific pump and dump where a lot of people are going to get hurt. So that's my 2 cents on that. Okay, it doesn't look like we're going to have Joe this week, but I am going to re-invite him on another call. Maybe I can even do a special mid-month call. I'll try to do that and see if we could just talk about the gold then. Okay, now here's your time to put in your stock symbols. We're going to spend the rest of our time here, which is just about 23 minutes, just analyzing your stocks. So the first one that came up comes from D, asking to analyze BCOR. Let's take a look at this. This is Blucora Inc. Now, if you could, I see a couple of people like Sean and Ralph. If you could, before you just throw a stock symbol in there, could you please tell me what your intentions are? Or, in fact, what your positions might be? Okay, that would be a good thing. All right, now, here is my immediate spin on this one. At first glance, I would be a seller of this stock. Now let me qualify this, okay, D? You put your first initial in there only, so I'm calling you D. Now, if I own this stock and I bought it, let's say back here on this bullish engulfing pattern, or right here in this bullish engulfing pattern. Let me zoom in. Right, we have a bullish engulfing pattern here. We have a bullish engulfing pattern here. While the stock is going up, you see the volume is going up. Right? And that's good. That's positive, right? If you see the volume going up as the stock is going up, it means the momentum is on the buy side and the buyers are still coming in. But what do we see today? This is not just a little drop in volume. This is a dramatic drop in volume. So there's a lot of things. Now, at first glance, I see all these things come out all at once because I've been looking at charts for almost 40 years. And so immediately I see some things popping out. I have a long stretch of green candles. What's that called, folks? That's a stale green light. I see a drop in volume on the way up. That's bearish. I see a long stretch between the moving average and the price. The rubber band is being stretched. And I see in the past that when the stock gets that far above the moving average, they tend to sell it. It's even back here. See? Okay. I see an area that is a role reversal right there. Boom. Former support back here, once broken here, turns into resistance here. So my forecast for this is going to be right there, just like that. So if you own it, I would put a stop right below today's low, because for the past for the past 1, 2, 3, 4, 5, 6, 7 days. So for the past, I'm sorry, more than that. 1, 2, 3, 4, 5, 6, 7. For the past 8 days, we've had higher lows and higher highs. My guess, and you might want to even, this is being recorded, so you want to track this. My guess is that tomorrow we're going to have either a lower low or a lower high. Now, you could have a higher low and a lower high. I don't want to confuse you here. But my guess is we're going to have tomorrow what we call a half signal. That's when you either have a lower low or a lower high, not both, but either or, and that would give us a half signal. That would be my sign to get out. And if I owned it, I mean, my gut would be taking profits right now. I'd be selling all of it. If you're thinking about buying it, that means I would wait. I would wait for a pullback to at least this support level, which would be a role reversal support, or a bounce off of the 20-period moving average. Either one of those things would be a new entry point. But right now, this does not look like a great entry point at this particular point. So hopefully that helps you out, D. Okay, Now, Sean is looking at Twitter. That's ticker symbol TWTR. Let me put that in there. TWTR on the daily chart. Big volume. See the big spike here? Now, we took a profit. We made money on Twitter. And this is a big green candle on good high volume. So Sean was thinking about taking a long position at 24.75. That's a tough call because you really have to wait until the end of tomorrow to see if there's higher volume tomorrow to get in. I don't like the fact that it's so stretched. Again, that rubber band is being stretched. I would feel more comfortable buying it on a bounce after it's pulled back. So today it gapped up on good volume. My guess is that tomorrow the volume is going to be lower tomorrow. Looks like Kramer had something to say about Twitter today. Let's see. Jim Kramer examined the power of analyst upgrades and what they could mean for your stocks. Just so you know, my plan for 2018 is to go on tour with Jim Kramer and Tony Robbins to analyze the markets. We're going to take a road show out there, so I'll keep you posted on that. So Jim Kramer made some comments. There's other comments about Google and Facebook and such, but there is an old saying, you buy the rumor, sell the news. This one just does not feel comfortable enough for me to take a long position. However, Sean, if you do decide to take a long position, I would keep my stop right below that former resistance, which is now going to be support. So if you buy it at 24 and change, I would put my stop right around 22.20 or right around 22. I give yourself maybe a $2.5 risk per share and move on from there. Now, John just has FB for Facebook. John, if you have a position or an idea in mind, that would help. Now, Facebook, this is interesting because Facebook, as you can see, is a lot different than Twitter. Now, they're kind of in the same category, but fundamentally, Twitter actually is in better position to build revenue stream. Facebook has not figured that out yet. And let me tell you, I know a lot about Facebook in this area. Facebook launched, some of you who are on Facebook, they launched Facebook Marketplace, which is more or less a classified ad section that allows people to post things for sale. My guess is that as Facebook builds that, they'll start charging people to list products or ask for a percentage of the sale once it is sold, like a classified ad. But until then, they haven't quite figured out how to monetize the model. So although it's in an upward trend, and it's fairly close to the moving average, you have a drop in volume today on that red candle. What I would say, John, is that if you get a breakout of these highs, I would feel more comfortable actually buying it over those highs than to try to buy it on a downtick or try to buy it when it's pulling back. So this is an interesting combination. Almost looks like a mini head and shoulders pattern there, although it's not. It looks like one. Head and shoulders patterns take weeks and weeks to form. But that one, if you're going to buy it, I would watch out and protect it. Remember, folks, when I first started this web seminar tonight, I started looking at the general markets. I talked to you about the cycle. I talked to you about the January effect. I talked to you about profit taking. Talked to you about what the hedge fund managers do. If they start selling off in the last week of this year to buy small caps, then you might want to move away from the large caps and start shopping in the small caps, hence the Qs. You look at the markets that are in the NASDAQ market. Those are usually the small, the mid-cap stocks in that area. Don't look for the listed stocks because that's where the large cap stocks are going to be. So hopefully that'll help you out. Okay, Ralph, your question is on Twitter, and hopefully when I covered it for Sean, you were helped with that. So okay, hopefully that helps you out. And I just see D just added a comment that you said you previously owned but want to buy again. Again, I would just move with caution and be smart. Just keep your stop in place. All right, now Ken is looking at GSM. Now, again, folks, I don't know about this particular company. I'm just analyzing it technically. My gut instinct immediately is to buy it. That's what the charts are telling me immediately. Why? Because on Friday we see a hammer pattern. Today we see an extended green hammer right there. And we see a slight drop in volume. But here's the kicker. That drop in volume is okay because the drop in volume is occurring as the stock is going down. So the drop in volume tells us that the sellers are slowing, and that long shadow underneath tells me the buyers are moving in. So I like that one. All right, Ken, now my forecast on this is not going to be a home run. I think this one could absolutely rally to test the highs from last week. So if you're looking for a short-term trade, I would say you can get in there, put your stop maybe somewhere below the low of today's shadow, and then trail your stop as it goes up. But that one looks pretty good, and so far the technicals are supporting that. All right, Brian, I'm going to try to catch up as quickly as I can to some of these. Brian, I see you put in Costco, C-O-S-T. Now, as I'm looking at these stocks, remember, I can look at a chart and almost at a glance tell you whether the buyers sell it. I don't like the way this one looks. It's gapped up. You have a breakaway gap. You have another gap here that was filled, and then you have what I would call an exhaustion gap. When you have three gaps in a row, the last gap is called an exhaustion gap. And after the third gap in the row, you have to be very mindful of volume. And you can see here again, volume is dropping dramatically with these inverted hammers, long shadows on top. So my forecast for this one is that it's going to pull back to at least that moving average. Now remember, this is recorded. So I hope you all, when you get the recording, look at this recording 3 weeks from now or next month. Go back and look at every single thing I talked about, because I'm drawing my lines here for you. I think I'm going to be right the large majority of the time on here, but I want you to have that evidence so that you can become a good chart reader yourself. And that's all it's going to take. So you bought it at 157.87. So you have a stop at 191. I tell you what, Brian, I would move my stop down just a little bit. And I don't want to have to cost you potential profit here, although you're already in a profitable position. But right here would be the gap fill point. You see that? So let me see where that gap is. That would be right at 189.46. So if you put your stop at 189, that gap, there's an 80% chance that that gap will fill. But after it fills, there's an 80% chance the stock is going to go up after it bounces. If it doesn't go up, it's going to come back to the moving average, hence the reason why I put the target there. So I would move my stop down just a little bit, because if you don't and you have your stop at 191, guess what? 191 is right here. The stock will come down, stop you out, go down a little bit more, bounce, and now you're kicking yourself in the head for putting in a stop loss order. Well, the only mistake there would be that you put the stop in too high. You put it in over support. You got to put your stop below support and make sure that you are protecting your position that way. The other thing you could do, Brian, is if you want to hold on to the position, you might want to look at selling some covered calls. If you have enough shares, maybe sell a call or two to collect a premium that'll give you a little bit more cushion to ride a downturn while still protecting your profits. You know, if you sell a slightly in the money call, let's say you sell the January 185s, you could still take in a premium, and you'll most likely sell the stock, but you'll get paid a premium on the way out. Okay, I don't want to get too far into the option strategy there, but you can do it. All right, let's see. Ralph, your comment there, take a long position. That was with Twitter. Okay, I got you there. All right, now let's go to Mike. Mike is considering selling, so he's looking for an exit point on NNN, which is National Retail Properties. I think a good selling point is now. All right, here's why. Again, in a second I can look at it. I immediately see this gap here. Okay, look at that. The gap is right around 44. You're pennies away from that gap fill. 80% chance the gas, this is gap fill rules. You can even ask Joe Spinelli when he comes on next time. When a gap fills, 80% chance that it will. After the gap fills, there's an 80% chance that it'll pull back from the gap point. Okay, we saw that happen here. See, gap filled, boom, well, close to filling right there, and then reversed. If you look at gaps, I don't think I have any more in this particular chart, but that gap rule is unbelievable, and people sometimes think it's a magic trick when I forecast the gaps. But look back here. Can you see this? Let me show you. I'll zoom in so you can see how the gap behavior is. Right here is a gap. You see that? There's the gap. Stock went up after the gap. See, it rallied, came back to the gap fill point, went one more day, formed a hammer, and then reversed. Boom. See, 80% chance after the gap fills, it'll reverse. So we're at this gap fill resistance point up on top. So here's what you can do, Mike. If you're considering selling the position, I would immediately sell half, at least half the position right off the bat, and trail the stop with a very, very tight stop just below today's lows. Okay, so if today's low is 43.23, I would put my stop at 43.20 or 43.19, because we have a long stretch of higher highs, higher lows. If you get a lower low tomorrow, it's probably going to pull back the days after that. So sell half immediately, trail the stop with a tight stop, and now you're in good position. You've locked in your profits. Okay? Now, Joe Campbell looking at DOG, which is Dogs of the Dow, right? Like that. I don't know about buying calls on that one, Joe. Although I think the market can turn down and correct. I just don't like this trend. This has been in a long-term trend. Look at the weekly chart. Boom, 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 lower lows. This is like you're catching a falling knife. If you're looking for something to protect your position in the event of a downturn, at this point, I would either sell out of some of your positions to lighten up, expecting a short-term sell-off. You got to understand, folks, if this tax reform bill passes, the market's anticipation of that will be relieved, and you actually might have people selling on that news. Right now, they're buying. It's the Trump rally. It's the phenomenon. Never before in the history of any presidency have we had this many consecutive highs in 1 year. Never before in history. That's Trump optimism. Whether you like the guy or not, you got to understand investors love him. And so if he comes over this hurdle and comes out with a huge win, they're still going to keep attacking him. Don't get me wrong. They're not going to give up attacking this guy. But the market and the investors will start to feel some relief, and they'll say, okay, the markets are going to pull back a little bit. Let me move to cash. I'll reposition when we find the new low, or wait for a bounce, and I'll get back in then. But they're going to take a break. They really are going to take a break, I believe, from the market, and it's not a dumb thing to do, is to move some of your money to cash. Okay. David is saying, what are your thoughts on Boeing? Now, Boeing is a defensive stock. That's ticker symbol BA. And you got to see here, David. This is, remember I talked about the fan lines? Let me do this for you. Let me erase this line. I'm gonna construct fan lines for you here, going back on Boeing from the first turn in the upward trend. So I'm going to the ultimate low right here, and I'm connecting to that low. You see that? So it's low to low, first two lows, and I move it out and project out. So I'm extending my trend line. Even though I know it went higher, I'm extending the trend line this way. Now watch how I build the fan lines. Then I go to the second low on that trend. Joe, did I just hear you, man? Just heard some more noise in the background. I guess not. Okay. Now go start my second accelerated trend line or fan line from that point. And I go out and connect to that point, see? And I extend that out. There we go. Then I go to the second one in that line. I connect the lows. There's my trend. I go out there. I could even, there's my third trend line. Now, boom, here's my most accelerated trend. Now, this is what you typically see right before a sell-off. 3 to 4 fan lines. Remember the Bitcoin thing? 9 fan lines? Come on, 9 fan lines. This is 4, and you can see it's going extreme. Now, the other thing, remember, this is a weekly chart. It's only Monday, so that volume is going to be low because there's only one trading day of the week gone by so far. But notice, you're going to have to keep an eye on this one, David, because if you've owned it for 5 to 6 years and you're in at $60, I'm not saying you got to really go ahead and take your profits and pay the tax on that, but you definitely want to put a stop somewhere below the second fan line, because there is a good chance it's going to break through fan line 4 and come back to fan line 3 and then maybe bounce from there. We'll see. But if it breaks through fan line number 3, you don't want to subject yourself to that much of a pullback, because now it's going from $300 a share down to $240. That's hurting you now. Okay, it's in your IRA, but that doesn't mean you have to let it ride. All right, if it's in your IRA, I don't know what kind of IRA you have, but you know, it's tax deferred, so I'm guessing that you're not going to have to pay the tax on that. But geez, might as well protect your position. Now, what I would ask is if your IRA is set up for option trading, because if you put a stop somewhere below fan line number 3 and you want to get long the stock again, then what you could do is sell puts. Some IRAs allow you cash secured puts to collect a premium to challenge the market to get long the stock. David, if you have a question about that, contact me directly so I can explain. I only have a couple more minutes left here, and I don't want to leave you hanging. But call me directly or email directly, and I'll give you the whole idea of what that means to sell cash secured puts in your IRA. It's not a speculative strategy. It's an accumulation strategy where you get paid to take a long position in your stock. And I think that would be the best thing, because let's say if you sold the stock, let's say you sell it at 286, you can then go into the market and look at January, February, maybe February or March even, and sell out of the money. You could sell out of the money puts. Let me go into, let's go to February. You can go into Boeing, look at this, and then you sell the 275 puts for $4. What does that mean? They're paying you $4 a share if you're willing to obligate yourself to buy it lower at 275. And you just keep selling puts in your IRA. That's cash money in your pocket as long as you're willing to own the stock. Now, Joe Spinelli, when he comes on, he'll tell you war stories about what we used to do on the trading floor. I was always selling options. Always. I was always short the volatility. And I loved it. And I made a lot of money doing that. But the equity options are a little bit different. You got to treat them with respect and make sure you're managing your risk in the process. Folks, I did not run out of content, and I certainly didn't run out of stock symbols from you. I just ran out of time here right now. Let me just give you one other little tidbit. All right. On January 25th at 4:30, January 25th, I'm doing a special web presentation on the cryptocurrency market for TradeStation University. TradeStation is a major online broker. They've asked me to come on to talk about the risks of cryptocurrency market and how to protect yourself against it. Again, I'm the only voice of reason out there that seems to be talking risk management to these folks. And so they asked me to join them for an hour presentation. So it's January 25th from 4:30 to 5:30. Mark your calendar, and then I will post that to the Market Guy Facebook page where you could register for free, listen in, and get another education on how to trade the markets. Folks, I had a great time. Hope you did too, and we'll talk to you soon. So long.
This video segment is a small part of what the Market Guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.